This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on counterparty risk. Let me give you a personal example of counterparty risk. We're in the middle of our economic shutdown here because of COVID-19, and I had my family, including my 3 sons and my wife and I, we dug up 2 trees. We planted some azalea bushes. We worked out in the yard for about 3 hours yesterday, and it was a lot of fun, bonding, and we were laughing and carrying on. But however, when the day was over, I said to my boys, I said, look, you work 3 hours. I may pay you minimum wage. I'll even give you a bonus. $30. And they said, Dad, there's no way we would have worked this hard for just $30. And I said, wait a minute. When you guys want to buy PlayStation games, when you guys want money to go shopping, when you come and you say to me, hey, Dad, can I have this money or can I borrow this money? And I say, well, how are you going to pay me back? Well, they pay me back by, studying hard and getting good grades and sometimes working out in the yard. Anyway, my point is that I am exposed to tremendous amounts of counterparty risk, as I'm sure you guys who have children are the same way. So if you remove the family nature of my example and expand it to include activities between and among individuals like ourselves and financial institutions, the whole range of financial institutions, then you get the sense of this counterparty risk. Is that other person going to pay you when they have promised to pay you? All right, so if you look at the learning objectives, they pretty much summarize what I've been just been describing. Describe counterparty risk, transactions that carry counterparty risk, what kind of institutions are involved. And then we have a bunch of definitions that we'll have to cover. Credit value adjustments, that's going to be an interesting kind of a concept as we move through the topic. And then, look at that third to last one. You guys have heard me say this before. Identify the risks, quantify the risks, and then manage the risks. So we'll talk about that. And then we'll have a discussion on some derivatives in the last slide or two. All right, so let's go ahead and give this definition here of counterparty risk. The risk that one or more parties in a financial transaction will fail to fulfill. And so this means the failure to fulfill means at least 2 things. The failure to fulfill in a timely manner, but then to fulfill the terms in their full. Somebody could always come to you and say, hey, I owe you $100, will you take 90? And you may say yes. And so this counterparty risk arises mostly because of default, but it can also occur because of the unwillingness of that counterparty to fulfill the terms of the contract. Now, let me give you just a quick example. Suppose you and I agree to trade this calculator. So I have my financial calculator here, and let's suppose that we decide to agree that in 3 months' time, you are going to pay me $50 for this financial calculator. Well, you may be extremely willing or extremely unwilling to fulfill your side of the contract at the end of 3 months. Suppose that for some reason that the price of this financial calculator in 3 months is $500. And you come to me and say, hey, Jim, let me have that calculator. Here's my $50. And I'm saying, wait a minute. I could sell it over here in the spot market for $500. I may not be willing to sell it to you. So there's your suffering because I'm not willing to fulfill the honor of that contract. Even though I could, right? I have the calculator, so all I have to do is hand it to you. Now this goes back to what I learned back in my original investments days, even as an undergraduate student. There's the ability to pay and the willingness to pay. So that's really what it is. Default would be the ability. All right, let's go back to the example of the calculator, right? So what did we do? We decided today to trade in 3 months' time for $50. So we have this pre-settlement time period, the remaining lifetime of the transaction. So that's 3 months. So what happens to the price of the calculator over that 3-month period? Well, I mean, it could go up to 55 and then down to 45 and then up to 60 and then down to 40. Now, of course, calculator prices don't fluctuate that much, but just grant me that scenario. And so notice that the squiggly lines tell us that exposure, right? The exposure is going up on the vertical axis. So that's, I don't really have a good explanation for why it squiggles and squiggles and squiggles. There's probably some anecdotal evidence that's thrown in there, but nevertheless, it's upward sloping, so we can live with that. But then what happens is that there's some settlement period. Now, in my simple example, I'm just going to hand you the calculator and you're going to hand me that $50. But some derivative contracts and other contracts are much more complex. There might have to be an unwinding of another loan. There might have to be identifying pricing of a collateral or marking to market or all sorts of stuff. So that settlement period might not be just the 5 seconds that it takes for you and I to exchange the calculator for the $50. So note that there's this pre-settlement risk and then there's the settlement period risk. How about the difference between counterparty risk? So let's do that at the bottom there. The value of the contract in the future is uncertain, right? We agreed to trade at $50, but if the spot price of a calculator is $100 or $200 on the settlement date, then the value of that contract, is huge. But today, when we sign that contract, we really don't know what that future value is going to be. So that's uncertain. Now, one of the ways to handle this uncertainty is to force both of us to do this marking to market, which of course is prevalent in futures markets, organized exchange futures markets. But the rules for marking to market in other contracts, sometimes it's just like you and I can agree, hey, let's mark to market on these particular dates. So note in the bold there I have, highly uncertain. And this risk is bilateral, right? So we have risk to the other, counterparty risk. Lending risk, on the other hand, only has one side, and that's the creditor. The notional amount is known at any time with, of course, some high level of certainty, but it's only on one side. Now, transactions that occur through an exchange, like the New York Stock Exchange or any of these other organized exchanges throughout the world, they're generally free of counterparty risk, mostly because of the existence and the efficiency of clearinghouses. And so those clearinghouses then take care of writing contracts, separate contracts with the short and the long position. And so what the chapter does, it tells you that we're going to focus on over-the-counter derivatives. All right. And one example is this idea of a repurchase transaction. And those of you who keep track of current events would probably know that the repo market has been in discrete levels of turmoil over the last, 6 or 8 months. The repo rate has jumped all the way up to 10%, sometimes a little bit lower. And the repurchase market is really quite a simple one. I mean, if I own a treasury bill today and I own it, and let's suppose I'm going to hold it, I plan on holding it until it matures in, let's just say, 3 months' time, and let's just suppose that it's selling for 97 out of 100. And so I have this sitting on my balance sheet, and every day, the price might go up or down depending on what interest rates, but over time it's going to increase in value to 100. But all of those fluctuations are really just unrealized gains and losses for me, and if I'm holding on to maturity, I really don't care about those, right? Especially if I hold this treasury security, I know it's a default risk-free. And so, I had this asset that's worth 97, But suppose I don't have any cash, and for some reason I need cash today. So I may sell that to you today, and so I sell it and I get $97. And then I agree to repurchase it from you tomorrow for, let's say, 97.5. Let me just pick a big number there. And so today I have this 97 and I can do whatever I want with it, right? I need to do stuff with it, and I'll talk about what I can do there in just a second. But then tomorrow, hopefully, I'll turn that $97 into $98, and then I can repurchase my treasury from you, right, for 97.5, and so I made a bunch of money in there. You're happy because you earned that rate, whatever 97 versus 97.5 is. I'm happy because I used those funds. So that's the general idea of the repurchase market. But these things have expanded to include all sorts of stuff. Investment firms use these all the time. REITs use these all the time. I mean, there are even long-term fixed income repos to fund the purchase of long-term bonds. But the underlying theme of these repurchase agreements are that the collateral is typically very liquid and marketable securities, like a treasury security. And of course, there's counterparty risk, because when I sold you that treasury for 97 today, I agreed to buy it back from you tomorrow. But suppose I took that 97 and instead of investing it wisely, I went to Atlantic City and I put it all in the red or put it all in the black, and I lost it all. So tomorrow you come and say, "Hey Jim, where's my money?" And I say, "It's over in Atlantic City. There's nothing I can do about it." And so you may say something like, "Well, what do you have, Jim? What do you have?" It's a contract, right? It's a legal and binding contract. And I might say, "Well, I have something over here, like a bar of gold." And you might say, "Well, I don't really want a bar of gold, but how much is that worth?" And I might say, "Well, it's worth 92. And you might say, "I'll take it." There's the haircut. Other clear examples, and we've talked about forward contracts in the past, and any investments class or any international finance class or any international economics class goes into great detail about forward contracts in the currency market. But these work the same way as with the calculator, right? Instead of us agreeing to trade this physical calculator, we agreed to exchange, let's say, US dollars for Canadian dollars. In this example here, I have euros. And so both of us are exposed to counterparty risk depending on whether the exchange rate moves in our favor or against our favor. Interest rate swaps are a little bit different, mostly because, with the exception of a currency swap, there is no exchange of principal at the inception of the contract. So you and I could agree to trade a fixed rate. So notice I have at the bottom there a fixed rate, 5.6 and 5.7 depending on the two banks, and then LIBOR plus some rate. And so look, the swap dealer in the middle wins all the time, whether interest rates go up or interest rates go down. But there's no exchange of principal. All we're going to do is exchange the difference between the fixed rate payment and the floating rate payment, and we're going to net those payments so that if I owe you, well, let's just say it's 4.7. So I owe you $4.7 million, let's just say. And then you owe me, suppose LIBOR is, well, can I do the math quickly here? Suppose LIBOR, is 5%. So you owe me $6 million. I owe you $4.7 million. Well, we'll just net those payments. So the netting reduces that counterparty risk. And remember, interest rate swaps, they could be over almost any period. And remember, we're talking about over-the-counter interest rate swaps. You and I could agree to trade these every week, but we're probably not going to do this. What we want to do is match up the cash flows of the derivative with the cash flows of the underlying bond if one of us is trying to hedge maybe the ownership of a fixed or a floating rate bond. And so typically these interest rate swaps have the netting every 6 months to match up the semi-annual coupon payments. Now, equity swaps, they probably do this every quarter to match up dividend payments, but there's nothing preventing them from having an arrangement where it's monthly or weekly. But most of them are quarterly or semi-annual, and so that netting reduces counterparty risk. Now, when I teach my derivative securities class, I show students how to set up an interest rate swap, and then we have an Excel spreadsheet. So, we pretend interest rates go up and interest rates go down. So you can see all the different possibilities in there. And so I ask them, I say, all right, suppose the interest rate is moving way against you. And you're still a month away from that settlement period. What can you do? Well, then I layer the interest rate swap with another swap contract, or I layer it with an option on a swap contract, or I layer it with a futures contract or some other crazy derivative, so that, you think about, I love those interest rate trees, so we go out all these different paths. And if you're not careful, if you go way, way up here or way, way down here, that counterparty risk is great. But if you start layering with extra swaps, you kind of reduce that risk. Credit default swaps, kind of work the same way. Remember, in a credit default swap, I own a bond, and I'm worried that I'm not going to get that par value of the bond at maturity, let's say in 5 years. So I pick up the phone and call you. You're a banker. And I say, hey, if I don't get the $1,000 from this company, will you pay me that $1,000? And the bank, they always say yes, because that's what banks do, right? They're in the business of creating contracts. So the bank says, sure, I'll pay you a contingent $1,000 in 5 years if you pay me, let's say a certain amount every year. It works kind of like an insurance contract. That's one of the great advantages of having access to the Bloomberg terminals. I put my students on there, and we can actually go and see the price in basis points of these credit default swaps. And we compare companies, like Johnson & Johnson with, maybe some other countries out there that, have almost no capacity to repay those bonds. The point is that, what is the bank? The bank's counterparty risk is that if I don't make those, let's say, annual payments to the bank, maybe I don't make those annual payments because the bond that I bought, the bond that I own, used to be a BBB rated bond, and then it was migrated to single A, then double A. Now it's a AAA rated bond, so I'm pretty likely to get my 1,000. On the other hand, suppose the bond goes down to, C rated, and then it's in default, then I have to worry about you. I have to worry about you paying me. Counterparty risk in a credit default swap. So, it works. What did I say? It works pretty similarly than interest rate swaps, but it's not quite identical, because here we're doing the netting of the payment, and here I'm paying you, this annual amount, this annuity. Over the life of the credit default swap, which is probably 3 years or 5 years. But remember, this is the over-the-counter market, so there's nothing preventing me from asking you to write me a 100-year credit default swap. Now, there's probably no reason for me to do that, and there's probably no reason for you to sign it, but I could always ask. Remember, it's the job of the financial institution to price whatever the client wants. How about institutions that are exposed to lots of counterparty risk? So notice on this slide, we're dividing it up into the large and medium and small derivative players. Of course, these large banks, they operate in multiple derivative markets at one time. So they've got these contracts on their books. And since they're so big, it's relatively easy for them to post collateral. For medium-sized derivative players, they probably do this sometimes, but they're probably going to get away with it with not posting collateral if they can. These are hedge funds and pension funds and probably some smaller banks. And then if we go down to the small derivative players, these are, they're definitely small financial institutions, but they could be, these gigantic corporations Like a company like Southwest Airlines. I mean, they use futures contracts to hedge their energy price exposure all the time. And so because Southwest Airlines is this big, they may or may not have to post collateral, but they probably don't. And notice that circle point in there. They may be looking to hedge their investments. So you have Southwest Airlines looking to hedge their exposure to oil prices. You have a company like Kellogg who's trying to hedge its exposure to, corn and wheat. What else do you put in cereal? Sugar, cocoa, all that kind of good stuff. Now, remember when we were looking through those learning objectives, I said there's a bunch of definitions here. So we'll focus on some of these definitions now. Credit exposure refers to the loss suffered in the event that the counterparty defaults. Back to my example with the calculator, what's the maximum credit exposure? The maximum exposure is what I say we were going to agree to trade for $50. But, I may ask you, now all I get is a promise from you to pay me that $50 for the calculator. So I own the calculator, so I have the calculator. And let's just suppose that I'm willing to hand over the calculator to you. I'm able to hand the calculator over to you. But I'm worried about you paying that $50 to me. So I may ask you to post some collateral, right? So you may have this beautiful gold pen, and I may say, put that gold pen into a trust. And maybe that gold pen, maybe it's worth $50, but maybe it's only worth 30, or maybe it's worth 70. Let's not worry about how much that's worth. It's just some collateral. All right. So, then that credit exposure changes, right? I can sell that pen if you default for let's say the $30. So I get back some. So that's the party A has the positive and party B has the negative. Now, let's complicate life here in just a bit, and I think I'll pick up on this on the very last slide or so. Suppose that you didn't own that pen fully, that you borrowed some money to buy that pen. What did I say? It was worth $30. So let's suppose you went to the bank and took out a $20 loan. Oh man, so that just complicates life even more. Credit migration, we've talked about this many times in the past. So look at the arrows. So we're going to swing from a double B rated bond up to a triple A rated bond, or we're going to swing from a triple A rated bond down to a double A rated bond, even a double A plus rated bond. So credit migration is just the change in credit quality. And notice I put the word discrete in there because the ratings agencies, they're not changing these things every minute of every day like stock prices or credit default swap prices change every day. These are over discrete intervals, maybe months, maybe years in between a credit change. All right, so you have deteriorations or you have improvements. And so future default probabilities tend to decline when we're looking at periods further and further into the future. We've also talked about recovery rates and loss given defaults. And so there's that big old formula that I'm sure you guys memorized from previous slide decks. 1 minus the loss giving default. So the important part about recovery rates and the loss given default goes back to my example with the pen and our calculator. So if that pen is worth 30, right? So I'm going to recover some of that, and then the given default, well, that depends on what that value is worth, because right, the pen's value, it was 30 when we started out, but the pen's value by the time you decide not to pay me, it might be 70, it might be 90, or it might be 0. Now, one of the complicating factors here, especially with over-the-counter derivatives, is that loss given default may not be immediately determined because that pen it's probably not too liquid. It might not. No one else in the world might want to own that particular gold pen. And so there might be some credit derivative out there that we might not be able to sell. All right, mark to market, we talk about this in other derivatives conversation. Present value of all the scheduled payments that a party is expecting to receive, less those that it is obliged to make. Remember, marking to market does not constitute an immediate liability, and that's why these markets have margin accounts. So both sides put up a margin, and then that marking to market then eats into the margin on one side and then gets deposited. It gets deposited to the other side. Of course, marking to market can be positive or negative, and let me just quickly go back to an example I gave you guys, one of the great movies of all time, Trading Places. At the end of the movie, Mortimer and Randolph Duke, they lost, $300 or $400 million. And the president of the exchange comes down and says, that we value all contracts at the end of the day. So it could be positive or negative. Next time you watch that movie, I'm not asking you to feel sorry for Mortimer and Randolph Duke. But the next time that's on television, watch it and scratch your head and think, okay, how can they come up with these hundreds of millions of dollars? So positive or negative. And of course, Eddie Murphy and Dan Aykroyd, if you think about this from a global perspective, they were exposed to counterparty risk if Mortimer and Randolph couldn't come up with the capital. Now, on this futures exchange, of course, there was a clearinghouse, so Eddie Murphy and Dan Aykroyd, they were okay, and everybody was happy on their end at the end of that movie. Replacement cost of an equivalent transaction with another counterparty, and this goes back to what I was saying to you that I teach my students in my derivative securities class. When we get way away from the forward price, we layer it with another contract. Now that next contract, it could be the identical and opposite contract that we had originally signed, but it could be some other kind of a contract. So in this case, replacement cost, think of it as an equivalent transaction. But in my earlier example, that would include any other transaction that would lead us to hedge. How about this concept of cross-product netting? Notice in the table here I have a bank and a counterparty. So let's suppose I'm the bank and you are the counterparty, and we have a trade. Let's suppose it's a forward contract and we're trading Canadian dollars. And right now I have a positive mark-to-market, you have a negative mark-to-market. And then we have another trade that is another forward contract, and this time with another currency. Let's suppose it's the euro, and I have a negative mark-to-market 15, and so you have that positive. All right. So what's the exposure in the absence of this cross-product netting? Right. We've got two different forward contracts. Now we're the same people, right? I'm the bank and you're the counterparty. So without netting, then my exposure is that 20 million that you owe me. Your exposure is the 15 that I owe you. And so with this cross-product netting, then that eliminates your counterparty risk, but I'm still exposed to the 5 million. So that's a good simple table there to give you the sense of how this works, cross-product netting, which is different than, where am I, all the way back here, with interest rate swaps, where we're just netting those two payments, fixed for floating. All right, I didn't mean to give you vertigo by going through those slides so quickly. Collateralization, of course, this goes back to the pen, the example that I had for my calculator. And remember that the collateral can be almost anything. The most accepted collateral, of course, is some kind of a treasury security. Close out immediate cancellation of all contracts. So this will be a net payable or a net receivable. These closeouts can occur for lots of different reasons. Remember what I said in a previous slide, the lack of the ability or the lack of willingness. But what it does then, since the contract is canceled, it moves from a marking to market issue to an actual realization of a net gain or a net loss. Other ways to manage counterparty risk. Yes, always trade with high, powerful bank, Rock of Gibraltar bank. Don't trade with Jim's little community bank where he doesn't have any assets. And then there are walkaway features too that help. But notice this first block point here. Methods used to mitigate or manage risk, they're never 100% effective. You cannot eradicate the risks completely. So when I say this to you guys, identify the risk, quantify the risk, and then manage the risk. So this is what we're doing in this manage the risk. This is why I tell you guys and I tell my students regularly that you've got to manage the risk on a continuous basis, because that risk that's quantifiable still has lots and lots of confidence intervals. And then there's the uncertainty about things that we have no control over or that we have no ability to predict, kind of like this virus situation that we have now. How about 3 levels of quantification for this counterparty risk? At the trade level, at the counterparty level, and at the portfolio level. So at the trade level, we're looking at a trade between you and me for one particular forward contract, let's say, at the trade level. But we can also do it at the counterparty level, where I may have multiple trades with you and I may have multiple trades with a bunch of other counterparties out there. And so I can combine the netting, I can even combine some of the collateralization so that each are considered an individual party. Or we can look at it as a portfolio level where we need to consider the relative value of one position versus the overall portfolio value. And this is the same thing that we talked about with equity securities. How about a credit value adjustment, and compare that to a credit limit? Remember when we talked about callable bonds, we divided callable bonds into their risk-free component and then their call feature component, and then maybe some other kinds of things. And so, the convention is when you look at some kind of a fixed income security, look at it as 2 parts. A portion that has no counterparty risk and a portion that recognizes counterparty risk. So look at the illustration I have towards the bottom there. So the total value of the derivative or whatever the contract looks like has 2 components. It has the risk-free component and then it has the counterparty risk component. And that's the credit value adjustment that's added to the risk-free value to get that total value. Credit limits, on the other hand, they put a cap on the amount of the amount of counterparty risk taken. Now, these credit limits and the credit value adjustments, these are used, pretty regularly. Now, a great exam question would be that these credit limits, what they tend to do is they limit counterparty risk at the portfolio level, but the credit value adjustments work at both the trade and the counterparty level. This is pretty much a summary slide of kind of what I've been talking about earlier, but it uses some option terminology. Positive mark-to-market is known as in the money. Negative mark-to-market is known as out of the money. And so if you look at positivity and negativity in terms of option terminology, then you get a sense of what the level of counterparty risk might be. So let me show you this in a graph, and this is taken right out of the chapter. And so note the mark-to-market goes up the vertical axis, but on the horizontal axis, there's just an arrow over there, and that is when how about if I do it this way? This would be when the spot price and the forward price would be identical. The spot price and the derivative price would be identical. And so what happens here, that let's go back to my calculator example. What did we say? $50 for the calculator. And let's suppose there at the origin that the spot price of a calculator is $50, right? So the value of the contract is 0. But what happens when the price of that calculator starts going up to, let's say, $70 or down to $30? Well, we need to figure out whether we're on the upslope or whether we're on the downslope. And so suppose that this price, well, let's go in the opposite direction. Suppose that the price of this calculator falls to, let's say, $30. So what's happening here? You agreed to pay me $50, but you could go in the spot market and get it for $30, right? That's the gray portion there, counterparty risk and funding cost. Now, before I get to the light blue part, let me come over to the next part and do the next gray. So suppose that that price goes up to $70 or $80, and you had agreed to buy it from me for $50. Well, I may default, or I may decide not to honor that contract. So then you have counterparty risk, because I might not be willing to sell you the calculator at $50 when I can go and sell it for 70 or 80, whatever I said it was. All right, so those are the gray areas there. Counterparty risk, either the counterparty or your own, and that's a funding cost then and a funding benefit that might have to do with things like margins and collateral and some other kinds of stuff. Now, the absolute differentiation there, where we go from the gray line to the blue line, this is where there's a requirement for collateral. So note that if the mark to market, if the positive or negative moneyness goes high enough or low enough, then both sides might be required to post collateral, and then they may get to choose what that collateral is. It could be a pen or it could be a treasury security. All right, so remember that, this is the way I think of this graph. The gray areas, these are kind of like the normal fluctuation, right? The spot price of this calculator, which was 50, and then the forward price was 50, maybe it goes up to 52 and down to 48 and up to 53 and down to 47. So those are kind of the normal ranges in that gray area. But then when it gets out of that normal range, and remember, you and I can probably determine what that normal range might be. But clearly, if the price goes to 30 or the price goes to 70, boy, we might start thinking about collateral, because the willingness and perhaps the ability of the counterparty, whether it's you or me, to fulfill the terms of the contract, might be questionable. Now, how about some X-value adjustments? These are different types of value adjustments relating to derivative contracts. So, and what your chapter does is it tells you about an umbrella, and it gives you all these definitions, and I'll give you those here on the next slide. But going back to my pen example, suppose that you put up this pen, so there's collateral, and then on top of that you had to borrow to buy that pen. So maybe you took out a loan for $20, so you owe the bank $20 plus interest. You're using that $30 pen as collateral for our forward contract, and there's a governing body out there that says something like, oh, this gold, it has to be 14 karat gold. It can't be 10 karat gold or 8 karat gold. I'm making this up. I have no idea about gold. But there's some regulation that throws on top of this. So these XVAs here are described, and these are pretty much definitional here. So we already did the credit value adjustment, and we already did the debt value adjustment. And we talked a little bit about the margin value. So, once we get far away, we may have to put up an additional maintenance margin, or we may have access to that margin. So clearly we have an initial margin, but then we have to maintain it. The funding valuation adjustment, this occurs when the dealer has to recover their average funding costs. So you have this collateral value adjustment inside of that pen, and then your banker that you borrowed that $20 from, maybe it's a floating rate loan and the interest rates have gone up, so you have to worry about that. And then there might be an option inside of that where you had sold an option you gave somebody the right but not the obligation to buy that pen that you're using as collateral. So there's an embedded optionality in there, and there might be some holding capital requirements. So that's pretty much a summary of what these terms are. And that takes us through our counterparty risk. Those of you who made it through the over 1 hour video from the previous chapter will be happy that this one wasn't an hour.